should be. I think it's really symptomatic of a bigger problem. And that bigger problem is that the banks are in a panic about more and more deposits leaving. And when was it the decision of these banks to tell us what we could and what we couldn't do, or when we can and when we should or shouldn't move? They never say that about moving into to an S&P index fund or into a mutual fund or whatever it may be. And who gave them that authority? To me, it's very concerning. And those banks, if they're going to that length to make it that difficult to move your money, you ought to think about moving all of it immediately.
Popular financial commentator and precious metals analyst Andy Schectman has raised alarm about the newest tactic by banks in the United States to discourage depositors from investing in precious metals like gold and silver. Andy, the president of Minnesota-based bullion dealer Miles Franklin Precious Metals, says his company was recently contacted by a bank, presumably to confirm if the firm is really a certified bullion dealer on behalf of one of their customers that wanted to make some significant purchases from Miles Franklin. To an onlooker, this sounds like a harmless good deed by a bank showing genuine concerns for the safety of their customers' resources. However, Andy warns that it is only the beginning of a nasty can of worms that is about to swiftly descend on people who still have large deposits in banks. According to the Miles Franklin president, banks are not just issuing fraud alerts when depositors try to make wire transfers to bullion dealers. They are also outrightly asking customers if they are certain that investing in precious metals is the safe thing to do at the moment. That is nothing short of manipulative behavior from the members of an industry well known globally for doing just about anything to achieve its goals. With bank deposits dropping by over $70 billion just 2 weeks ago, Andy says the goal of banks is to drastically reduce all outflows. So they will manipulate, gaslight, and do just about every other thing to keep your money. Andy also warns that as the banking crisis worsens, and practically everyone is saying it will, these banks are going to get even more desperate to avoid large outflows, which could cause bank runs. That is why the renowned analyst is warning that the right time to get your money out of the banks is right now. Even tomorrow might be too late because the entire industry is sitting on a keg of gunpowder. Just one bad news and everything could go up in smoke. We will now bring you clips from Andy's recent interview with the economic ninja. Please watch, share, and like this video as Andy discusses what's happening in the banking sector and how you can use precious metals and other assets to protect your wealth. Also, ensure you subscribe to the channel and turn on the notifications so you get instantly notified when we upload a video. Thanks and enjoy.
It's not normal, but it's becoming normal. And they spoke with my operations manager who said to the bank, yeah, this is all legit. You can release the funds. And they said, well, we need to have it go through compliance. And the response back was, well, no, you don't. Why do you have to let it go through compliance? This is the client's wishes. Yep. Well, we have to make sure that it goes through compliance. But we have seen, we go back to the order that we did last year for $50 million. One of the two orders that we did of that size, it took the lady almost 5 days to get the money wired. And that's why she wanted us to tell the world about it, that, hey, it's one thing. It's very easy to write the bank a check for $50 million and have them take it gladly. It's another thing to get it out. And what we view as our money, remember, we're unsecured general creditors to the bank. What we view as our money and our ability to get it is becoming much more difficult as these banks struggle with the mass exodus of deposits leaving in search of yield and of safety. So yeah, I think it is becoming normal and will become much more normal as well. No, I think that they've actually created some departments or positions at these banks called client retention management, because they are losing clients, they are losing deposits. It's a mass exodus, and this is not going to change. But people need to remember that when these depositors leave, especially if we see large deposits leaving or many of them leaving, this is what got Silicon Valley Bank into trouble. Now, that was a bank run, but the premise is the same, that these banks are undercapitalized and over-leveraged, and they're leveraged with what they thought was good assets, that being mortgage-backed securities and treasuries and muni bonds and all of these things that have lost 50 or 60% of their value. And if they aren't capitalized enough with money in-house in order to meet those deposits, they're forced to sell these assets at a loss, which really, really hurts them. So they're doing all they can to mitigate not only the speed in which the money gets out, but to take the bold step of pretending that there are parents or our guardians and looking out for our best interests. And my question is, at what point did any of these banks ever become that entity that we have asked for? They're looking over our shoulder to make sure, look, if the client comes in and says, I'm a big boy, I'm a big girl, this is what I want to do. I have verified the wire instructions. This is where I want the money to go. Call the company. The company says the address is right, and it still needs to go to compliance. There's something really wrong with this. And it isn't your money, it's their money. And they're making the determination when and how easily, and if at all, that money gets released. That to me is rather concerning, and probably the beginning of a trend as more of this happens. And heaven forbid we see a bail-in, which should have happened a long time ago. These banks should not have been bailed out. That's part of the Dodd-Frank Act. We see a bank get bailed in and watch the craziness when people run to pull their money out, and watch what happens then. So yeah, I think this is something we're going to see a lot more of.
At this stage, one must ask, why are banks trying to stop people from investing in precious metals when they will not try to do the same if the money was going into an S&P index fund or into a mutual fund? The answer, in our opinion, will not be far-fetched. They know something big is on the horizon for the banking industry and the U.S. economy in general, and that in periods such as this, many investors will prefer to exit into safe haven assets like gold and silver. So Andy's summation that this is going to get way worse is not at all far-fetched. There are going to be many more restrictions placed against investors who want to divert some funds into gold and silver. Before that happens, you need to ensure your funds are sufficiently protected and you are not at the mercy of the collapsing banking industry. Let's get back to Andy's interview.
Look, it's one thing for us to sit here and say, stock market's overvalued and over-leveraged and risky. The real estate market, the bond market, it's one thing to espouse economic theory and talk about how it could affect your investments. It's another thing altogether to say, hey, by the way, the money in the bank, well, it's not safe. And if they fail, the fact that these banks were bailed in or gobbled up by JP Morgan or Bank of California, which, by the way, JP Morgan was on the back end of that. I have a very good friend who's one of the top analysts at JP Morgan. He said he spent all week on that PacWest Bank of California deal himself in New York City. So the point of it is that these banks that have fallen already have been gobbled up or consolidated by JP, or were bailed out by the FDIC, supposedly not at the cost or at the expense of the taxpayer, which is a bunch of malarkey. The bottom line is that they're supposed to be bailed in. That's what the Dodd-Frank law said. And when you see that happen, you will see, I believe, a massive amount of anxiety, unlike anything anyone's ever seen. And that's what we're seeing now. People are saying, look, you know, I don't feel safe with my money in the bank. And so gold and silver represent, I think, something outside the system that carries no counterparty risk. And that's really what it's all about. It's not about becoming wealthy. It's about keeping your wealth and removing the counterparty risk and the systemic nature of the problem. So it's a different mindset primarily altogether. And I think you see an event like any of these regional banks failing, and Janet says, no more bailout, no more consolidation, we're going to bail in. And people will understand what that means. It is law. The fact it hasn't happened yet is only delaying the inevitable, and that inevitable will be a panic where that M2 line will fall off a cliff. And I just think that we're not there yet, but that is the difference, is that people are focusing not on their investments as much as they are their savings, and the chance of losing that is pushing them here. It's also worth mentioning that this isn't just related to the regional banks, the ones that carry all the 70% of the commercial real estate loans, of which $1 billion plus have to reset over the next 15 months. This is also about the commercial banks, where the biggest money in the United States is rapidly pulling their money out of the commercial banks as well, and going directly to treasurydirect.gov would be my guess, or into precious metals, or into things outside the banking system. Because look, if you go directly to the Treasury and buy short-term duration treasuries, 6-month treasuries, you're betting on the U.S. government. And if the U.S. government fails, well, the banks are in big trouble, as you know, as is right there. So to see the amount of money actually dwarf money coming out of the commercial banks are dwarfing what we're seeing coming out of the regional banks. And those people, I would argue, are a little bit more well-informed. So this is not just an issue of money leaving the regional banks, it's also the commercial banks. So there is strain across the entire system. And as rates keep rising, more strain and more problems. So again, I don't think this is an isolated deal. I don't think that this is something that we'll look at the end of the year and say, geez, that was a scary deal. Good thing we got by it. I think it's just the very beginning, and I expect to see much more. So look, if you're concerned about your money in the banks or have too much in one bank, be proactive and mitigate your exposure. Spread it around. I've heard you say this before, over several banks. Go directly to the treasurydirect.gov and buy short-term treasuries, buy precious metals, do whatever it is you want to do, and do it before it becomes very difficult to do. It's already getting tough.
In other news, the Congressional Budget Office, CBO, a federal agency that produces independent, nonpartisan analysis of economic and budgetary issues, is revising its projections for this year's U.S. budget deficit. The recent report, the agency states that its revised projections for the budget deficit is that government expenditures will be higher than revenues by a whopping $1.7 trillion in 2023, a 13% increase from what was projected 4 months ago. The report reads, on the basis of its estimate of the deficit through July and preliminary estimates of revenues and outlays in August and September, CBO now expects that the total deficit for 2023 will be $1.7 trillion, or about $200 billion larger than its May estimates. CBO Director Philip Swagel recently had an interview with CNBC where he stated that the U.S. government is facing a challenging and unusual situation. The economy is recovering, he noted. We're past COVID, the labor market is looking much closer to normal, and yet the deficit is still wide. The CBO director also noted that it might take a miracle to bridge the wide gap. The challenge we face is that the fiscal deficit and trajectory are so difficult that even super optimistic growth is not enough by itself to make us sustainable. Growth will help and will make the policy environment better, but ultimately policymakers need to make some choices whether on spending or on revenue, Swagel told CNBC's Joe Kernan. The projections for the United States economy, both in the short and long term, remain very gloomy. Yet, banks are trying to stop depositors from moving their money into true safe haven assets that have withstood the test of time. Please share your thoughts on Andy Schectman's interview in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.